We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets. Global equities roared higher this week. The S&P 500 and Nasdaq hit fresh records as cooler U.S. inflation ignited hopes of a Fed rate cut, now priced with near certainty for October 29th. Europe joined the rally with PMIs back in expansion and consumer sentiment improving, while the UK surprised with resilient retail sales. In Asia, Japan surged on political stability and stimulus optimism, even as the yen weakened toward 153, and China's markets climbed on tech optimism, despite sluggish domestic demand. The mood? Pure risk on, but built on fragile faith that central banks will deliver. Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
What a week in the markets, ending October 24th. We saw this really impressive global surge.
Absolutely. Broad-based, pushing past those macro worries, geopolitical stuff. It felt different.
Yeah, it wasn't just drifting higher. We hit fresh record equity highs. And, it wasn't just the usual suspects, mega caps, yes, but also smaller companies, Asia, pretty much everywhere joining in.
We're calling it the triple shot that fueled this.
Right. So first, that unexpected coolness in U.S. inflation. Second, massive hope building around central banks maybe easing off.
And third, you just can't ignore the sheer earnings power of those big tech names.
Exactly. So our job today, as always, is to dig a bit deeper than those headline numbers.
Right. We need to understand the mechanics here.
Yeah.
Is this rally solid? Or is it, maybe built on something a bit shaky underneath?
So we'll break it down region by region, the U.S. first, then jump over to Europe and the U.K. After that, Asia, Japan, and China specifically. Lots going on there.
And then, crucially, we look ahead. Next week is packed. We'll cover the key events and give you our top 5 risks to keep on your radar.
Okay, let's start with the U.S. then. Unpack that triple shot narrative there. The momentum was clear. S&P up nearly 2%.
Nasdaq even stronger, up 2.31%.
And interestingly, small caps too. The Russell 2000 jumped 2.5%. That suggests broader participation, which is usually a good sign, right?
It usually is, yes. And a lot of that was down to the inflation news. That was the big surprise.
Yeah, tell us about that CPI print. September CPI came in cooler than expected.
That's right. Expectations were for 3.1% year over year. It actually came in at 3.0%. And maybe more importantly, core CPI stripping out food and energy also dipped.
Okay, so that really feeds the disinflation story.
It does, and the market immediately jumps on that. If inflation is cooling faster, maybe the Fed can cut rates sooner.
Which brings us to the policy bets.
Precisely. Look at Fed funds futures. Now they're pricing in get this, 97% chance of a quarter-point rate cut next week, October 29th.
Wow, 97%. That's almost saying it's a done deal. That would be the second cut this year.
If it happens, yes. It's a huge amount of expected easing driving this optimism. It's really the main engine right now.
But is the market maybe getting a bit ahead of itself? I mean, 97% feels very confident, especially when other data like PMIs look okay.
That's the million-dollar question, isn't it? You're right. The data wasn't all pointing downwards. The S&P Global Composite PMI actually hit 54.8.
Highest since March, I saw, led by services.
Exactly. So the market is kind of having its cake and eating it too. It sees cooling inflation, which it likes. It sees okay-ish activity, which supports valuations. And it still expects the Fed to cut because of that inflation number.
A Goldilocks scenario, perhaps.
Perhaps. But it hinges almost entirely on the Fed delivering that cut next week. Very little room for error in that assumption.
And even with this broad rally we mentioned, the underlying strength, still pretty concentrated.
Oh, incredibly so. This is where you really need to look under the hood. We talk about the Magnificent Seven tech stocks. Right. Their earnings are expected to grow nearly 15%. Compare that to the rest of the S&P 500. Their growth expectation is less than half that.
So the whole market's performance is massively reliant on just these 7 companies delivering.
Pretty much. It's a huge concentration risk.
Yeah.
If one or two of those big names stumble on earnings, well, the whole rally starts to look a lot less stable for the average investor.
Definitely something to watch. Okay, another interesting signal this week was in the bond market, this kink in the yield curve.
Yes. Short-term Treasury yields went up, but the 10-year yield actually dipped.
Which seems counterintuitive. Why does that kind of move matter?
It signals conflicting expectations, but maybe not in the way you'd first think. The rise in short-term yields isn't really pessimism about the near term.
Yeah.
No, it's traders basically front-running the Fed. They expect that rate cut next week, so they're adjusting positions now, pushing those short-term yields up slightly in anticipation.
Pricing it in.
Exactly. But the dip in the 10-year yield, the longer-term view,
Yeah.
that suggests the market thinks, well, maybe the economy will need that Fed support down the line. There's still uncertainty about long-term growth.
So near-term confidence in a Fed cut, but longer-term questions remain.
Got it. Okay, let's move across the Atlantic. Europe and the UK also rallied.
They did. The SDXX Europe 600 was up, 1.68%, also helped by better PMIs, a bit of a lift in consumer sentiment.
Seen some green shoots there.
Definitely seeing some resilience. The Eurozone composite PMI climbed to 52.2. That's the best reading since May last year. And manufacturing actually hit 50.0.
50 is neutral, right, so stopping the contraction at least.
Exactly. And consumer confidence hit an 8-month high. So the narrative that Europe was heading for a deep slump, well, it seems to be holding up better than feared, structurally speaking.
But hold on, isn't there a big split within the Eurozone? I'm thinking France.
You're absolutely right to flag that. The overall improvement hides this really deep divergence. France, activity there has been shrinking for 14 months straight now. 14 months, that's significant. Why should someone investing globally care so much about France specifically?
Because it's the Eurozone's second largest economy. If France is stuck in this rut, it acts like an anchor on the whole region. Germany might be stabilizing, Spain might be doing okay, but that French weakness really caps the upside for the Eurozone as a whole. It handicaps the potential.
Okay, so a key structural issue to monitor. Now, compare that to the UK. The FTSE 100 actually outperformed, up over 3%. What's driving that?
Yeah, the UK story is quite interesting. It wasn't really about inflation, surprising to the downside there. Inflation held steady at 3.8%. Core eased a bit, down to 3.5%.
So not an inflation story.
Not primarily. The real kicker was retail sales. They rose again in September, 0.5%. That's the fourth month in a row of increases.
Wow, what's driving that spending?
Seems to be specific segments, actually. Things like gold, technology purchases. The takeaway is that the UK consumer is, hanging tough, as they say.
And that matters for the Bank of England.
Big time. It gives them more confidence. If they are thinking about cutting rates maybe in December, this stronger consumer backdrop makes it easier. They can ease policy without immediately worrying about demand completely collapsing.
Okay, interesting divergence there between the UK consumer and parts of the continent. Let's pivot east now. Japan. Markets absolutely soared, neck and neck, up 3.6%.
Yeah, Japan was a big mover. And this part of the global rally really fits that policy optimism part of our triple shot narrative.
What was the trigger?
Political clarity, essentially. The markets really welcomed the new prime minister, Takeichi, her pro-growth stance, and the sense of coalition stability.
The new PM bounce.
Exactly. That immediately sparked speculation about fiscal stimulus coming soon to boost growth.
Yeah.
And stimulus hopes are like catnip for equity markets.
But there's a flip side to that optimism, right? The yen.
Absolutely. All this stimulus talk, combined with the Fed cut expectations in the U.S., just hammered the yen again. It's getting very close to that 153 per dollar level.
And the Bank of Japan is watching this closely, presumably. Core inflation is still sticky, running at 2.9%, well above target.
It is. And paradoxically, the new government stability might actually make a BOJ rate hike more likely, not less.
Oh, so?
The thinking is, if the government is stable and promising fiscal support, it gives the BOJ political cover to finally raise rates, maybe in December. Now seems the consensus to tackle that inflation, knowing the government can step in to cushion the blow to the economy.
So political stability enables monetary tightening. Interesting dynamic. Okay, last stop, China. Equities rallied there too, CSI 300 up over 3%. Tech optimism seemed to be the driver.
Tech optimism played a big part, yes. But it's happening against a backdrop of still quite soft domestic data. It's the classic China paradox we keep seeing.
What's the paradox this time?
Well, on one hand, Q3 GDP looks solid. Came in at 4.8% year over year. That keeps Beijing on track for their roughly 5% annual target. Industrial output was strong too, up 6.5%.
Okay, sounds good.
It sounds good, but why is it good? It seems driven mainly by exports and industrial production for overseas markets. The internal engine, domestic demand, is still sputtering.
Ah, so making things, but not necessarily selling them at home.
Precisely. Look at retail sales up only 3.0% year over year. That's weak. Fixed asset investment actually slipped 0.5%. The Chinese consumer just isn't feeling confident enough yet to really open their wallets, despite the policy signals.
But policymakers are thinking long-term, aren't they? We had the fourth plenum conclude this week.
Yes, and they laid out the blueprint. Lots of focus on tech, self-sufficiency, boosting advanced manufacturing key themes for the upcoming 15th five-year plan.
So the takeaway on China is long-term strategic direction is set, but near-term growth is still waiting for that domestic consumer to wake up.
That's a good way to put it. Investors seem to be betting on the long-term plan, but the immediate economic pulse still feels a bit weak internally.
Right. Okay, that sets the stage nicely for looking ahead, because this coming week, October 27th to the 31st, it looks absolutely critical. Central bank's meeting, key data dropping.
It really could reshape the narrative. Let's start with the U.S. The big one is Wednesday, October 29th, the Fed rate decision and Powell's press conference. That's where that 97% probability gets tested.
Then Thursday, we get the first look at Q3 GDP. How healthy is the U.S. economy, really?
And Friday wraps it up with the PCE price index. That's the personal consumption expenditures index, the Fed's preferred inflation gauge. It's arguably more important than the CPI print we just discussed.
And you mentioned a potential issue there.
Yeah, the ongoing government shutdown. There's a risk that some of these key data releases, potentially including PCE, could be delayed. That adds a layer of uncertainty nobody needs right now, a real wild card.
Okay, definitely something to watch. What about Europe? Also busy.
Just as busy. Thursday the 30th is the key day there, too. You've got the ECB rate decision. Plus, we get flash Q3 GDP figures and the first look at October inflation for the major Eurozone countries.
And anything earlier in the week?
Monday the 27th, we get the German IFO Business Climate Survey. Always a good temperature check on Europe's largest economy.
And Asia. What are the highlights?
Two big ones. The Bank of Japan rate decision also lands on Thursday the 30th. Will they stick to the script of hinting at December or surprise us? And then China finishes the week with the official NBS manufacturing PMI on a Friday the 31st. So yeah, a huge amount of information hitting the markets globally.
Which brings us perfectly to our final section.
Yeah.
The top 5 risks checklist. Given the rally, these are the things you really need to keep an eye on.
Absolutely essential right now. Okay, risk number 1, the U.S. Fed meeting. It's binary. Does Powell deliver the expected second cut of the year, validating everything? Or does the data disruption from this shutdown, or maybe just caution, lead to a pause? A pause would likely trigger a sharp negative reaction, given how much is priced in.
Right. Risk number 2.
GDP checkpoints. Those Q3 growth numbers from the U.S. and the Eurozone, they will set the tone. Do they confirm resilience, supporting risk appetite? Or do they disappoint, injecting doubt and potentially undermining the rally's foundation heading into year-end?
Number 3 must be inflation-related.
Has to be. The inflation gauge, specifically that U.S. PCE data on Friday, assuming it's released, this is it. Does it confirm the disinflation trend? Or does it challenge it, forcing markets to rethink that near certainty about the Fed cut? Huge implications.
Okay, risk 4 takes us back to Asia.
BOJ positioning. If the Bank of Japan punts again, delays hinting strongly at a rate hike, that probably boosts Japanese stocks further. But it all certainly pushes the yen weaker, past that 153 level perhaps, increasing the risk of currency market volatility or even intervention.
And the 5th risk, back to China.
China's PMI pulse. That manufacturing PMI on Friday, it's the first major data point after the plenum. Will we see any sign that the policy focus is actually boosting factory activity? Or will it confirm that industry still relies heavily on exports, meaning domestic weakness persists? A key indicator for near-term China sentiment.
Okay, so to wrap up this week's deep dive, the main story. A powerful global rally fueled by that potent mix, cooler inflation data, big bets on central bank easing, and some political relief, especially in Japan.
That's the surface. But the key challenge we keep highlighting remains. Underneath the record highs, there's this persistent demand softness. You see it clearly in France's ongoing slump, and you see it in the Chinese consumer still holding back. That's the structural hurdle.
Which leads us to our final thought for you to take away this week. Next week is pivotal. You've got 2 massive central bank meetings, the Fed and the ECB, plus crucial growth data. Any surprises here could completely flip the script.
Exactly. Complacency could be dangerous right now. While markets are calm at these highs, volatility might just be waiting for a trigger. And next week is packed with potential triggers. So, stay alert.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.